The local bourse was on a 3-month high today, ignoring weak leads from Wall Street and the region. I spoke to market watcher Martin Lakos from Macquarie Private Wealth earlier. Well, Martin Lakos, the All Ordinaries Index above 4,400, the ASX 200 above 4,300. We're off and running, are we?
Well, it looks like it's a little closer to a decisive move, Tiki, but at the end of the day, it's one day that we've broken above 4,300 on the ASX 200 as decisively as the market's been expecting. Last time we sort of saw these levels was back in October of last year, and I certainly think we need a couple more days like this to really give the market some confidence that we've found a new level. There's absolutely no doubt, though, the market continues to underperform, and we largely know what that's all about. It's lack of earnings growth across the broad market.
So you think the market is actually undervalued?
Well, we do. Look, we've put out a what we call a fair value estimate on a 12-month basis. So for this time next year, we expect the market to be at 4,593, to be exact. On the ASX 200, there's obviously a number of calculations that goes into that in terms of earnings and dividends. So there's about a 7% capital gain factored in and about a 5% dividend yield. But even so, with that possible gain in 12 months' time, Tiki, it does show us up to be underperforming the US. Just to remind you very briefly, August last year, the lows of the market through the European debt crisis, the Dow Jones has now rallied 22% since the 8th of August. We are up 9%. Gives the extent of that underperformance. And lastly, if I can touch on, it's interesting to watch the US market continue to rise, whereas as it rises, you'd expect possibly risks to be growing, and yet the main risk indicator, the VIX, is at 15 times. That has been in a range of about 13.5 to 48 through the last 12 months. So 15 times, markets aren't all that concerned on risk at the moment.
Well, very strange. Now, anything for the share market investor to take note of in the Reserve Bank's financial stability report?
Yeah, look, nothing in particular that would really get us overly worried. Lots of commentary about the concerns on Europe last year, and those concerns are easing quite clearly. On the domestic front, they certainly have noted that we're seeing a softness in manufacturing retail. Well, there's not really a lot of news there for the market in that respect, but they certainly don't think that it's deteriorating, which is obviously slightly better news. And certainly in terms of underperforming loans in the banking system, although we're at a 10-year low in terms of those underperforming loans, those loans are only 0.6% of total loan books across the banks. Now, to put that in perspective, that was in 2003 at about 0.2. So it's a fairly small amount of loans that are in 90-day arrears.
Now, Bank of Queensland has been placed on review for possible downgrade by Moody's. How has that impacted the share price?
Well, not at all. In fact, quite the reverse, Tiki. Bank of Queensland rallied 8% today. It may well be that the market has taken into account the issue in regards to how Queensland is going, that is non-mining Queensland. So clearly the bank's got exposure to southeast Queensland and those property values. That's a large proportion of that $328 million impairment write-off. But the capital raising's at a deep discount. They're raising $450 million to re-repair that balance sheet and keep Tier 1 capital intact. So clearly the market is focusing on that as against what the rating agencies are currently saying.
Martin Lakos, thank you again for talking to the business.
Always a pleasure, Tiki. Thanks.